Good afternoon. Welcome to the markets. Asian stocks were mostly up higher today. Investors were assessing the latest developments on tariffs and the U.S. non-farm payroll report out on Friday, which suggested that there was some weakness in the labor market, prompting some quarters of the market to anticipate U.S. Fed cuts sooner rather than later. Oil prices lost steam during the trading session after OPEC Plus nations announced that they would be hiking oil output by an additional 547,000 barrels a day from September. The Nikkei share average declined by 1.25%. The Hang Seng Index rose by 0.92%, while the Shanghai Composite Index gained 0.66%. U.S. markets took a tumble on Friday. This as the Trump administration continued to announce finalized tariff rates on some of its trading partners. Canadian imports will be subject to 35% import duties, and Switzerland a whopping 39%, with South Africa's import duty now confirmed at 30% late last week, which are set to come into effect on Friday. Other negative news coming out of the U.S. was that jobs numbers grew by just over 70,000 in the month of July, with previous month job growth downwardly revised and the unemployment rate edging up to 4.2%, raising eyebrows about the state of the U.S. economy. And that's before a barrage of higher tariffs are set to kick in. The Dow Jones Industrial Average fell by 1.23%. The S&P 500 declined by 1.6%, while the Nasdaq Composite Index tumbled by 2.24%. Looking at local indicators, we see that the all-share index is up 1% at 98,658 index points. The rand is trading at 18.03 against the US dollar, 23.94 against the British pound, and 20.84 against the euro. Gold is trading at $3,355 an ounce, platinum at $1,305 an ounce, while Brent crude oil is trading at $68.60 a barrel. All right, let's get into it now with Viv Govender. He's a portfolio manager at Rand Swiss. Thanks very much for joining us, Viv. So market players are clearly not taking the new tariffs regime well, and there are concerns around how this is going to impact on the largest economy in the world, that being the US. Can we expect continued weakness, especially given that the markets, particularly in the United States, have been reaching all-time highs, and this doesn't necessarily tally with what we're seeing in the real global economy?
Well, you must understand that we are seeing a situation in which the US market is kind of bifurcated. There is a segment that is dealing with technology that is doing really, really well. And you can see that from like the movements in things like Meta and Microsoft recently. And there's other parts of the economy that are not doing quite as well. To give an idea just how significant it is, if you had to look at, for instance, the last GDP number from the US, spending on AI contributed more to the growth in GDP than the consumer sector as a whole. Remember, the consumer sector is over like 2/3 of the US economy, just showing just how big the spending in AI and other technologies are towards moving that market. So yeah, I do think it's a case of we are seeing a very unusual situation in which how can I say, the amount of spending in this one particular area is kind of changing just how well the market seems to be doing overall.
So another factor that saw the US markets decline on Friday were the lower jobs numbers over the past few months, suggesting that the US economy is under some pressure. But what did you make of the fact that Donald Trump decided to fire the actual compiler of the jobs data because the numbers were not to his liking? That really sounds like it's slippery slope stuff.
It's more than just slippery slope stuff. This is, I can't even explain how strange this particular thing has been with regards to, firing, a person just because you don't like the results of a survey. Look, these surveys do have biases, they do have issues, but they're not something that's put in there, purposefully. What happens is you have these are surveys of a market, and those surveys obviously rely on the underlying trends remaining constant. Sometimes the underlying economy changes in ways that are unexpected, and therefore the survey will have a trend one way or the other. So yeah, it is a strange case of killing the messenger here. I don't think that the individual involved with regards to this was somebody where you could say, this person was, trying for some nefarious reason to change how the US's, jobs numbers looked, quite frankly.
What are your thoughts on the lack of unity between the National Treasury and the South African Reserve Bank on the latter's announcement last week that it would now begin to focus on achieving the lower part of the inflation target, that is 3%? And of course, the Finance Minister, Enoch Godongwana, he came out with a statement to say that unilateral decisions, he didn't say in so many words, but unilateral decisions like this are unacceptable because policy rests with National Treasury, which then has to be consulted with the executive and the president. What does all of this mean for policy and most importantly for us South Africans?
Well, I do think that if you had to look at the situation with the Reserve Bank, what they're trying to do long term, if it works out, will be very beneficial to us South Africans. If you can get the inflation rate up to 3%, that means basically, consistently the market expects it to be down at 3%. It reduces inflation, but it also reduces the interest that we have to pay for our debt. It would make servicing our debt much easier. It would make the country function better, etc. in the long term. The risk of this is that if there is a shock, and we wait since had to go back to 4.5% or maybe 5% inflation rates, and if your target is 3 now, then the market would expect you to start raising interest rates. Where in the past, it was a 3 to 6% rate, at 4.5% and 5% inflation rate would be not something that's going to trigger higher interest rates. And so that is obviously one of the risks that's involved here. I would obviously say that I think the Reserve Bank has earned the credibility, let me say, to do this kind of move because they have handled the value of the rand as well as our inflation rate over the last several years quite well. And if they think they can get it to 3% and keep it there without too much cost, I think that is something that we would think is likely to be true.
While we have time, what do you think is going to be the impact on South African listed stocks in terms of the 30% import duties into the United States? Which sort of sectors, if any, and stocks might be affected?
Well, I mean, if we do have this, rate go into place, the rand would weaken, and we've seen that happen already. And that obviously is going to help a lot of our exporters in the material sector. Gold producers, the platinum producers, etc., will probably benefit from a weaker currency. But you got to look at the impact on jobs. You have to look at the fact that we are likely to see, a number of people out there losing employment, and the government's obviously talked about that, maybe tens of thousands. I think we would find, SA Inc. as a whole would probably be the sectors that would be, hurt. So you'd probably find the Rand Fed stocks obviously benefit from the weaker currency, but you'd find the SA Inc. stocks, companies that benefit from the South African GDP being stronger, would be the ones that would be hurt.
Viv, thank you so much for your time and insights as always. That was Viv Govender. He's a portfolio manager at Rand Swiss.